Welcome everybody. We switch to the agenda. So we will briefly talk about the product landscape of structured products and where barrier reverse convertibles fit. Then I have chosen a barrier reverse convertible as an instrument to show the structure and mechanics of the necessary calculations. We will briefly discuss the PRIIP framework, its scope, the categories and the regulatory basis behind the calculation. We will talk about the market data preparation, the bootstrapping of the risk factors and the necessary principal component analysis if non-scalar risk factors are in play. We will have a focus on the calculation of the performance scenarios, the simulation methodology behind and the results they provide. And we will finalize with a summary risk indicator, the bar equivalent volatility calculation from the market risk measure, and the final calculation of the summary risk indicator. The EUSIPA product map and where the PRCs sit. EUSIPA is the abbreviation for European Structured Investment Products, for the European Structured Investment Products Association. And basically, they cover four main categories: the capital protection, the yield enhancement, the participation, and the leverage. The barrier reverse convertibles, this is category 1220 and 1230, depending whether the barrier reverse convertibles have certain features, belong to yield enhancements. And the key characteristic is that investors earn a fixed coupon in exchange for taking some downside equity risk. The barrier provides conditional protection, but if the barrier condition is not triggered, the investor typically receives nominal at par, plus of course the coupons. Otherwise, the investor can be exposed to downside in the underlying, often the worst of a basket of underlyings. The structure I have chosen is paying coupons in a fixed semi-annual way, regardless of the barrier effect. So investors receive yield in all scenarios. The barrier can be European or American barrier observed at certain observation dates or through maturity. In our case, I've chosen a European barrier, which is observed 7 days before the final payment date, plus of course the initial observation. I have chosen a slightly more complicated structure for the redemption and the payoff than it is in a standard barrier reverse convertible. One receives the nominal if the barrier is not hit. One receives the nominal if the barrier is hit, but all of the underlying equities are above a certain cap level. And one receives the nominal times the worst case ratio in the else case. And additionally, the product yields what we call participation. So there's an additional payment at the recommended holding period, which is the expiry date of the instrument, depending on the basket performance itself. So whereas the cap level is taken into account for each underlying equity individually, there is also a participation on the performance of the whole basket itself. So let's summarize. We have the product, a barrier reverse convertible with multiple underlines. The underlines are Deutsche Post, 𝗏𝗏𝘀𝗏𝗏, and UPS. You see that all of the underlines are different currencies, meaning the whole structure is in a quantum setup. This means we also need the respective foreign exchange volatilities and the correlations between the underlying and the discounting currency. The barrier level is 81.5% of the initial fixing observed at the final fixing. So it's a European barrier. The coupon rate is 0.25% per annum, paid semi-annually, meaning we have 12.5% per coupon. We have a maturity date, which is also the recommended holding period in 18 months. This means we have to calculate one scenario at an intermediate holding period, so that one new scenario is necessary due to the regulatory, to the PRIIPs regulation. The participation, as I explained, is based on the basket performance and it's 200%. Example, if the basket performance is 105% and the basket level is 100%, this would mean we would have another 10% of the nominal paid at redemption. Then we did some calculation using unrisk. So the dirty value at today date, valuation date, the 26th of January 2026, was 0.8488. And we can split this in a bond component and an option component. And we have calculated the barrier hit probability with 71.6% under risk neutral measure with 4096 𝗏𝘃𝗀𝘆𝘁𝗶. The PRIIPs framework. So if we want to sell such a product, if the issuer wants to place such a product and sell it to or market it to retail investors, a PRIIPs kit is needed. The regulatory basis, the regulation number 1286/2014 PRIIPs. It's supplemented by the Commission delegated regulation, and there are several amendments in place. The scope is that PRIIP manufacturers must produce such a key information document for all packaged retail and insurance-based investment products if they are marketed to retail investors in the European Union. The barrier reverse convertible we take a closer look on today is a category 3 instruments. Basically, there are 4 categories of instruments: category 1, 2, 3, and 4. Category 1 means that there is the potential of a loss of all the invested or even more than the invested money. Category 2 are so-called linear instruments, so where the payoff is linearly depending on an underlying. Category 3 means that the payoff has a non-linear dependence on the underlying. And category 4 is for insurance product. So they normally include observables that are not directly measurable in the market. The data requirements are at least 2 years of daily, 4 years of weekly, or 5 years of monthly price history for underlines. Multi-underlying barrier reverse convertibles qualify as category 3. As we have seen in the description before, it's a highly non-linear investment or payoff. What does a kit need to contain? It has to describe the product, so there are 4 questions to answer. What is this product? What are the risks and what could I get in return? This is the summary risk indicator and the 4 performance scenarios. What are the costs? So impact of entry cost, of management fees, and so on. And how long should I hold it? So the issue of such an instrument tells you the so-called recommended holding period, and depending on this recommended holding period, you have to calculate more or less scenario values and offer more information on the kit. There's an obligation to review your kit. It must at least be reviewed every 12 months, but there's a revision required if the market risk measure class changes or moderate scenario returns changes by more than 5 percentage points. This means that you basically recalculate the key ratios of your PRIIPs kit, or the selected key ratios of your PRIIPs kit on a daily basis and monitor them. And if these changes are visible, you have to republish your kit with the updated numbers, but you have to review your kit every 12 months without any trigger. How is the PRIIPs kit calculation workflow? In the first step, you collect the market data. In our case, these are the spot prices, which are scalar risk factors, and the yield curves, which are non-scalar risk factors and which need then to be calculated using a principal component analysis. Step 2 is a bootstrap simulation. So the PRIIP regulation tells you how you build your 10,000 paths for the scenario and the MRN calculation. And the third step, you do the whole calculation, meaning you have to take the underlying instrument into account and create all the values along the bootstrapped paths. From these calculations, you get distributions and you calculate the performance scenarios by using respective quantiles. Based on these distributions, you can then calculate also the bar equivalent volatility to get the summary risk indicator by combining the market risk measure with the credit risk measure, and you can apply the cost disclosure by changing the annualized return values and calculate the costs as nominal values and as impacts to the returns. All in all, there are around 20 key ratios you have to calculate, and then they are put into a PRIIP KID output. The hardest part is normally to calculate the market risk measure via the distribution and the scenarios via the distribution. There are three different scenarios plus the stress scenario. Why is the stress scenario separate? Because you have to calculate a different distribution to calculate the stress scenario. The stress scenario reflects an exceptional adverse market outcome. It's derived from the first percentile of the simulated return distribution calculated under the stress assumption. It's not a worst case, but statistically it sits in the extreme tail of this distribution. You have the unfavorable, the moderate, and the favorable scenario. They are calculated with the standard market data, with the standard bootstrapping, and they represent the 10th percentile, the 50th percentile, so the median, and the 90th percentile of the simulated distribution. The same distribution can, in category 3, be used to calculate the market risk measure. It's basically the discounted to today's value, sorted, and then use the 97.5 bar percentile and formula given in the regulation. Market data preparation, the Scala risk factors are the equity spot prices. So you need each equity underlying, you need the historical daily log returns. These returns need to be bootstrapped with replacement to get the 10,000 draws for the PRIIP simulation. So 10,000 different paths, and as we have to observe barrier and we have to observe the value of the underlyings along the timeline, we have to build up 10,000 different paths with this bootstrapping. Especially important for the stress scenario, here is the difference to standard scenarios. The stress scenarios for Scala risk factors, you have to apply a stress volatility, where the stress volatility is calculated using a series of volatilities over time units. The curve risk factors need to be modeled by principal component analysis. There's an especially important thing. The stress scenario methodology for non-Scala risk factors is not provided by the regulation. So you have to take special measures to obtain a stress scenario for the curves. We do this by basically stressing the vector of the first three principal components and treat them as this vector is a Scala risk factor and apply this scaling factor to this factors of the principal component analysis. So, after drawing these random scenarios and the simulation of the spot price and the simulation of the yield curves, we price the barrier reverse converter. For each of these 10,000 paths, we compute the BRC payoff. So we check the barrier with barrier level, we check the final fixing with cap level. This gives us the distributions, and then we calculate the VAR and the VAR equivalent volatility. So we sort the 10,000 discounted payoffs, calculate this 97.5 percentile loss in the price space, and calculate the corresponding bar equivalent volatility. For the scenarios, we do not discount, but we calculate the distributions at the respective date. So 1 year into the take the respective percentiles into account. So if we take a look at recommended holding period versus intermediate holding period, intermediate holding period is also true for the 1 year scenario. The recommended holding period is defined at the PRIIP maturity date. The intermediate holding period is mandated by regulations for products with recommended holding period with more than 1 year. Why 1 year? We will take a look at the values. Why 1 year is more volatile in such a very reverse convertible setting? Basically, it's because you still have the optionality. You do not know how your barrier sorts out. This will explain the wide spread we will see between the year 1 scenarios, stress favorable versus the recommended holding period scenarios. The regulatory logic behind this that the intermediate scenarios protects investors who may not hold until maturity by showing the risk of selling early when market value can differ substantially from the par value. These are now from my point of view, most important slides, because we now want to explain how the scenario value at the recommended holding period and at an intermediate holding period is calculated. You see here a timeline, you see here 2 coupons, and to compare the value of the instrument at the recommended holding period across different scenarios, you basically have to compound all cash flows before the recommended holding period to the recommended holding period. And you have to add all cash flows that are delivered at the recommended holding period. So this is the final coupon. This is the nominal at par if the barrier is not hit, or the nominal at par if the barrier is hit, but the different individual cap levels are not breached in a down and in fashion. And the participation. If the barrier is hit and the individual cap levels are breached, you will get the worst of the 3 different individual equities. So basically, you have to value the barrier reverse convertible payoff at recommended holding period and compound all cash flows that have been in place before the recommended holding period up to this point. At an intermediate holding period, how is the scenario value calculated? Basically, now you have 2 components. You have cash flows that may already have occurred in the past with respect to this date. Again, you need to compound these cash flows, plus you need a mark-to-market valuation of the barrier reverse convertible. So basically, you need a valuation of the instrument at the intermediate holding period. Meaning, you need a very fast valuation because you need to calculate 10,000. You need to do this mark-to-market valuation 10,000 times because you have 10,000 scenarios. But each of these mark-to-market valuations is not an analytic formula, but is again a full valuation. So you basically discount all cash flows that are in the future with respect to the intermediate holding period up to the intermediate holding period. So again, for the scenario calculations, you have to discount and compound all cash flows to this date and create the distributions. For the MRM, you use the same paths, but you discount to today's date to calculate the value at risk date. So the key challenge for coupon period instruments, whether it's a barrier reverse convertible or, for example, a floater, that the scenario values must include both the expected coupon cash flows and the terminal redemption value, all discounted at the relevant risk-free rate, discounted or compound. For each scenario, the scenario value is the present value of the coupons remaining plus the present value of the terminal cash flows, plus all the cash flows that that need to be compounded up to this value. And it's a demanding computation because at each intermediate holding period, each mark-to-market valuation requires a full valuation. Here, in this case, we have a quasi-Monte Carlo simulation with 3 underlying, utilizing a 𝗥𝗶𝘀𝗀𝗁𝗁 model with quantum correction for each of the underlines. So you need quite good numerics to do this in a reasonable time. What are the results? We get stress, we get unfavorable, we get moderate, and we get favorable scenarios. You see here that the intermediate holding period, the year 1 scenario, has quite a large dispersion. This is due to the structure of such a very reverse convertible instrument. We have a market risk measure which is around 14.18%, which means we have a market risk class of 4. The credit risk indicator from the issuer is 3, so we end up with a summary risk indicator of 4 based on a scale from 1 lowest to 7 highest. So this means it's a moderate to medium risk for an 18-month worst of barrier reverse converting. How are the costs disclosed in such a calculation? Costs are normally applied on a post-processing step. So we have entry costs, and we may have ongoing costs and exit costs. And we calculate the returns, we adjust the returns based on these costs and show them as impacts there. So we calculate if it's 0.75% entry costs, then it means these are 75 euros entry costs, and we calculate this reduction in yield you get based on these entry costs, and we calculate this difference as an impact. What are the key takeaways now? You need an end-to-end workflow for a KID calculation. Yeah, you need to assemble the market data. You need to have the 10,000 half bootstrap simulation. You need to do the scenario extraction and calculate the VAR equivalent volatility and the summary risk indicator. Cost is merely a post-processing step. You normally have 2 types of risk factors, scalar and non-scalar risk factors. For scalar risk factor, the regulatory description is complete. With a non-scalar risk factors, and the stress assumption is not described in the PRIIP regulation. Interesting for barrier reverse convertibles or for this type of instruments is the intermediate horizon. The year 1 scenarios show substantially wider dispersion than the recommended holding period scenarios. This is economically plausible and commonly observed for this type of structure, as a midlife barrier reverse convertible carries remaining time value, barrier probability, volatility sensitivity, and in the correlation effects due to the correlations between the underlying, but in this specific case also the correlations to different currencies, as we have chosen 3 different currencies for the underlines. The methodology presented follows the Commission delegated regulation and the corresponding amendments. So now I think I'm still in time, and we can now switch to the question and answers. Let me check whether there are some. There are no questions and answers. If there are no questions and answers left, I will finish the webinar. Thank you for participating. If there are any further questions, feel free to contact us, and have a nice day.